Hi, this is J.R. Crooks for Money Markets TV. Most experts agree that currency trading is much more difficult than playing the other asset markets because it's dependent on so many different variables: interest yield, inflation, economic growth, international capital flow, trade deficits, monetary policy, fiscal policy, political risk. The list goes on and on. To make things even more complicated, the reasons for a currency's movements are often circular. For example, a rising currency can improve the economic fundamentals, and improving economic fundamentals tend to improve the outlook for the underlying currency. At certain times, investors get confused about what's actually driving the currency markets, and I believe this is one of those times. So today, I'll try to simplify things a bit. The legendary speculator George Soros uses a model for currency trading that includes 8 variables: nominal exchange rate, nominal interest rate, domestic versus foreign price level, level of economic activity, non-speculative capital flow, speculative capital flow, trade balance, and government budget. These variables produce a complicated equation, but I think we can boil down our decision whether or not to buy a currency to one all-important number: speculative capital flow. Funds flow at the margin is driven by the market sentiment, or expectations of investors, and these expectations ultimately drive short and intermediate term currency moves. So what determines market sentiment? Well, potential investors usually look at interest yield and inflation. If both of those gauges are rising, it tends to attract speculative capital flow. But this brings me back to my earlier point, that the currency markets are often circular. Do rising real yields cause the exchange rate to rise? Or does a rising exchange rate improve economic fundamentals and force interest rates to rise? For our purposes, that question isn't really relevant. As Soros says, expectations relate to expectations, and the prevailing bias can validate itself almost indefinitely. In other words, when a currency starts to move in one direction, that trend often feeds on itself. And that's exactly why we've seen large, multi-year trends in the dollar over the last 2 decades. But sooner or later, this self-feeding tendency produces an overshoot when the currency is over or undervalued. These overshoots precede major turning points in the market, giving smart investors a great opportunity for profit. But it's also possible to make money by riding the trend with the crowd when we think it has longer to go. The best way to determine which way to bet is by looking at speculative capital flows. I'm J.R. Crooks for Money Markets TV. Thanks for watching.